Hey, welcome to The Explainer. Today we're diving into one of the biggest and frankly most controversial ideas in all of crypto, stablecoins. They're meant to be this perfect bridge connecting two completely different financial worlds, but what are they really? And can they actually pull it off?
I want you to think about something for a sec. Imagine you could have all the cool stuff about crypto, the speed, the global reach, but without the crazy up and down price swings that give everyone a headache. What if you could just get rid of the volatility? That one question, right there, is the entire reason stablecoins exist. And it's an idea that could completely change how money moves around the planet. So, here's how we're going to break it all down. First, we'll get into the basics. What are these things? Then, we'll look at the bright side, the big promise they hold. After that, though, we have to talk about the serious risks hiding just under the surface. We'll see how regulators are trying to build a global rulebook for them. And finally, we'll look ahead and ask, what's next?
All right, first up, what exactly are stablecoins? The easiest way to think about them is as a bridge that connects the super fast, kind of wild world of crypto with the world we all know, the one with traditional currencies like the US dollar.
So at its heart, a stablecoin is a type of crypto where its entire job is to be, well, stable. It's designed to hold a steady value, usually pegged one-to-one with a major currency like the dollar. And the secret sauce to making that happen is something called reserve assets. The company that issues the coin holds actual, real-world assets. Think cash, government bonds, to back up every single digital coin they create.
And, this is a world away from something like Bitcoin. Bitcoin's value is just whatever the market decides it is, pure supply and demand. It's not backed by anything. Stablecoins are the total opposite. The goal is to always be worth $1. They are backed by assets, and they're issued by a central company, which, by the way, gives regulators someone to actually regulate. They're fundamentally different beasts.
Now, when you look at this market, it's not exactly a diverse playground. It's almost completely dominated by the US dollar. In fact, just two big players, that's Tether's USDT and Circle's USDC, make up about 90% of the entire scene. And that concentration of power is a really big deal, because it makes both the potential upsides and the huge risks we're about to get into even bigger.
Okay, so let's talk about the promise. Why is everyone so hyped about these things? Well, the people who believe in them see a future where finance is way cheaper, way faster, and accessible to way more people.
And the potential benefits here are pretty compelling. I mean, we're talking about slashing the costs and time it takes to send money across borders. Just think about workers sending money back home to their families. This could light a fire under old-school payment companies, forcing them to get better and cheaper. And it could open up digital finance to millions of people who've been left out, all through a simple app. And here's a real-world example of what that means. Sending $500 to family in another country might cost you just $5, maybe $10 with stablecoins. Using the old-school banking system, that same transfer could cost you $20, even $30. For millions of people, that difference is everything. That's literally food on the table.
And listen, this isn't just a theory. It's already happening. In 2024, about $1.5 trillion in cross-border payments moved using stablecoins. That is 3 times more than Bitcoin and Ethereum combined. So even though their total market size is smaller, they are already being used in a huge way for moving money. Okay, but it's not all sunshine and roses. For every promise, there's a potential problem. We have to talk about the risks, because that name, stablecoin, can be seriously misleading. And it all comes down to one terrifying question. What happens when stable isn't stable anymore?
This is the billion-dollar question. The entire system, and I mean the entire system, is built on trust. Trust that for every $1 point out there, there's a real dollar's worth of safe stuff sitting in a vault somewhere. So what happens when that trust just disappears? Well, you get the 21st century version of a bank run. And we don't even have to imagine it, because it already happened. Just look at March 2023. Silicon Valley Bank goes under. Turns out Circle, the company behind USDC, had over $3 billion of its reserves stuck in that bank. Confidence just vanished, boom, overnight. People panicked, they rushed for the exits, and this supposedly stable coin crashed to just 88 cents. The only reason it recovered is because US regulators stepped in and basically guaranteed the whole banking system. It took a massive intervention to fix it.
And the risks here go way beyond just one coin having a bad day. Think about it. A massive run could force these companies to sell off their reserves, like US government bonds, which could mess up really important financial markets. In countries with shaky economies, people might ditch their local currency for dollar-pegged stablecoins, which completely undermines that country's central bank.
Plus, they can be used to sneak money around capital controls or even pull so much cash out of normal banks that it could destabilize the whole system.
So, you've got this incredible potential on one hand and this massive danger on the other. What do you do? Well, regulators all over the world are scrambling to write the rules of the game. They're trying to build a framework that lets us get the good stuff while taming the very real risks. This quote from the Financial Stability Board really gets to the heart of what's keeping regulators up at night. They're not just thinking about how things work day to day. They're planning for the worst-case scenario. What happens when a huge stablecoin fails? You can't just let it implode. There has to be a plan for an orderly wind down so it doesn't take the rest of the financial system down with it.
But yeah, getting everyone on the same page, that's turning out to be a huge challenge. Just look at the different ways the EU and the US are handling it. The EU's new rules are pretty strict. They say foreign companies have to set up shop locally. The proposed rules in the US are a bit more flexible. This kind of patchwork creates complexity and a risk that companies will go rules shopping, looking for the easiest place to operate, which could undermine safety everywhere.
Despite all the differences, though, there are a few core ideas that everyone seems to agree on. First, one-to-one backing with safe, high-quality assets. That's non-negotiable. Second, you, the holder, must have a clear legal right to get your cash back. And third, the reserve assets have to be kept totally separate from the company's own money, so if the company goes bankrupt, your money is still safe.
So, all of this leads us to the big final question. Where do we go from here? What does the future actually look like for stablecoins? And maybe for digital money itself?
Well, the potential for growth is just mind-boggling, but so is the uncertainty. Just look at the forecasts for 2030. They range from $500 billion on the low end all the way up to nearly $4 trillion on the high end. That massive spread tells you one thing: nobody really has a crystal ball here. The future is going to depend on adoption, innovation, and maybe most importantly, regulation.
And at the end of the day, we come right back to that central conflict. It's the ultimate balancing act. Can we unlock all this incredible potential, the efficiency, the access, the new ideas, without also creating massive new risks that could threaten the whole global financial system? That is the tightrope everyone is walking right now.
So what are we really looking at here? Is this the beginning of a true revolution in finance, something that's going to make everything better and more open for all of us? Or are we just building the shiny new tools for the next global financial crisis? The final chapter for stablecoins, well, it hasn't been written yet.